This chart is the driver of Bitcoin. Hey guys, what's going on? Jeb here, and in today's video, I am going to explain why one chart is the absolute driver of the entire Bitcoin and cryptocurrency market. I'm going to lay out in a series of videos here how there are about 4 different major factors that are driving the price of crypto that are behind the scenes that you guys probably don't see very often or think about very much, but they are hands down the most significant impactors on Bitcoin. I'm telling you, they are more powerful than FTX collapsing, more powerful than Luna going down, and they are more powerful than any short-term news event, even bigger than Gary Gensler attacking the cryptocurrency market through the Securities and Exchange Commission. And this is the chart that drives them all, and we're going to talk about it in today's video. So without much further ado, guys, let's go ahead and dive right on into it. This chart is the balance sheet for the Federal Reserve. Now, you've probably heard of the balance sheet for the Federal Reserve before, but you might not know what it is. Essentially, the balance sheet tracks how much money and liquidity the Federal Reserve has created out of thin air and put into the economy through the purchasing of treasuries and mortgage-backed securities. Those are topics for another day, but essentially what the Fed is doing through this process is something called quantitative easing. This is a process that the Fed has not embarked on a whole lot other than in this century, starting right before the 2008 financial crisis, really ramping up through the 2008 financial crisis, and then kicking itself into overdrive during the 2020 pandemic. You can think of the balance sheet like this. Whenever the Federal Reserve wants to stimulate the market and inject liquidity into the market, what they do is they go and buy these treasuries and mortgage-backed securities with fake money, and so the people that they're buying those treasuries and mortgage-backed securities from now have money that did not exist before because it was created out of thin air by the Fed. Now they can sell those treasuries and mortgage-backed securities, and they can go and take that money and invest it elsewhere, essentially injecting money into the system. That was done to the tune of $9 trillion over the span of the last 13 to 14 years, starting right before the 2008 financial crisis, kicking into hyperdrive, moving through the pandemic. Now, whenever the Fed injects liquidity into the market in this way, a couple of things happen. Number one, there's a lot more money to go around, so it's far easier for the average investor to take some of the money that they had and go invest it in different things. For example, they could invest it in tech. They could invest it in real estate. They could invest it in crypto. And we saw a lot of that happen, as I'll show you on the chart here in a moment, so you can see the correlation between these two charts. But the flip side is that whenever you inject that much money into the economy, naturally, because of the laws of supply and demand, you're also going to see your currency, in this case the US dollar, go through quite a lot of inflation. And that's what's been taking place over the last 3 years, as we've seen nearly $5 trillion injected into the economy, at least up until about a year ago. That was at least until this point right here in April of 2022, when the balance sheet stopped increasing and it started coming to the downside. Now, if the Fed increases the size of the balance sheet by buying mortgage-backed securities and treasuries, the way that they let go of that money that's on the balance sheet is by something called roll-off. They let the mortgage-backed securities and the treasuries roll off by not renewing them, not reinvesting the proceeds into them, and then that money that comes out, they just let poof back out into nothingness. So, if increasing the balance sheet leads to higher liquidity, but also higher inflation, in theory, rolling off the balance sheet should lead to less liquidity, which does bring this tightening on the market. That's why it's called quantitative tightening. But it also, in theory, should bring inflation under control, which is something the Fed is trying to accomplish because they know that a couple of big geopolitical events are on the horizon. Number one, there's a demographical shift happening in the United States right now, the likes of which we've never seen before. The boomers, on average, last quarter aged into retirement, and that means that they took all of their capital with them. No longer will they be investing in the stock market, propping it up, inflating the balloon. Instead, they're letting air out of the balloon to pay for a new golf cart in Florida by their condo. On top of that, as Chinese and United States relations break down, and as Russia and Ukraine both are now basically offline from a geopolitical and trade sense, that means that the world has become much more difficult to trade in, and trade has gotten far more expensive. And considering the plethora of demographical crises going on right now in China, the entire Chinese manufacturing plant will likely be effectively offline within the next 10 years. That means in the next 5 years, the United States needs to onshore millions of jobs of industrialization. That leads to massive amounts of inflation, which the Fed does not want to compound on top of inflation that had already been brought about by all of this money printing. So the Fed wants to roll off the entire balance sheet by May of 2026, which would be the fastest reduction in the balance sheet in the history of the Fed. Doing so would lead to the largest quantitative tightening event in the history of the Fed, while also leading to, you guessed it, hopefully lower inflation and a more stable dollar. Now, for the part you came here for, why is this one of the biggest drivers of the price action of Bitcoin, and how does this play into where Bitcoin is today and will be over the next couple of years? Well, you can actually find this chart, the exact same chart that we were just looking at over here on the Fed's website, on TradingView by going to USCBBS. That's the United States Central Bank Balance Sheet is what that's short for, and you can see the balance sheet trend over time going back to 2003 when quantitative easing was really starting to take off and the genesis of this chart. There are a couple of major events here. Of course, we saw the 2008 financial crisis where a huge amount of money was added to the balance sheet in the first round of major quantitative easing. That saw over $1 trillion added to the balance sheet in the span of just a couple of months, and that, in theory anyway, helped to ease the fears of the 2008 recession turning into the 2010s depression. From there, to continue the stimulus of the economy, the Fed continued to buy treasuries and mortgage-backed securities, increasing the balance sheet up to $4.4 trillion, which is where they paused their increase. From there, the balance sheet sat at the exact same level for almost 3 to 4 years, and then we saw a correction on the balance sheet moving into 2019. Then the pandemic hit, and we went into another recession far quicker and, honestly, frankly, more severe and deep than what we saw in 2008. From there, the Fed leaned on old policy. This was something that happened, again, 12 years after 2008. They increased the balance sheet by $3 trillion in the span of less than 3 months, a 70% increase. And then in the same way, after the initial jump in the balance sheet in 2008, they led into another prolonged period of gradual increase. We saw the same thing occur through the golden era of inflation in 2020 and 2021. Running your economy off of massive inflation and a huge amount of quantitative easing is like having a diet of sugar. It's going to give you a lot of energy in the short term, but then you're going to crash, and you're going to crash hard. It's better to eat something that's going to give you more sustained energy than a massive spike and then a massive crash. So what do we see happen? We see the balance sheet plateaus in April of 2022 and then starts going through a correction. And now the Fed wants to roll off the entire balance sheet for the purpose of getting inflation under control by right about here, May of 2026, which is about 3 years away. That would mean that the balance sheet needs to do this. It needs to go down that quickly, that fast, and it needs to do it in 3 years. To do so would, as I said, be the biggest reduction in the balance sheet that we've ever seen. So why does this matter? Well, I'm about to show you the correlation between the balance sheet and Bitcoin, and in future videos, you're going to understand even more why this is important because of its impact on the stock market and the US dollar. But for today, we're going to focus on just the balance sheet and its direct impacts and correlations with Bitcoin. In short, if you'll remember, what happens whenever you reduce the balance sheet? Number one, you pull liquidity from the economy. Number two, you get inflation under control. Neither of those things are things that are very bullish for Bitcoin, and I'll show you how that shows up in the chart in a second. When you have less liquidity in the market, that means that people have less money floating around in profits on whatever tech stock they were invested in or real estate they were invested in to go and dump it into Bitcoin, which the average retail or institutional investor considers to be high risk. So they're not going to go and dump $100,000 into Bitcoin. They might dump $1,000 into Bitcoin. They don't have as much money to proportionally go and put into Bitcoin as they would before because the overall balloon has shrunk. There's less air to put into Bitcoin in the first place. There's just less to go around because this fake money that was injected into the economy is going away at a rate of $97.5 billion a month. That means less liquidity from which people can make investments into cryptocurrencies themselves. And this is probably even more important, less liquidity that venture capitalists can use to invest in new companies in the cryptocurrency space, making innovation and growth of the space a lot harder over the next 3 years as this balance sheet is rolled off. On top of that, in theory anyway, through the reduction of the balance sheet, through the principle of quantitative tightening, you should, theoretically anyway, bring inflation under control. Why was Bitcoin created? To combat rampant inflation and governments that are misusing the currency. If the United States population looks at the balance sheet reducing and they look at the effective federal funds rate being very high and they say, man, the Fed's hawkish. They really want the dollar to be strong right now. They're going to be less inclined to invest in Bitcoin because they're going to say, wow, the Fed's doing such a great job managing the dollar. It's whenever inflation is out of control that people look to Bitcoin. Now, inflation is probably going to be a problem for the next 3 to 5 years, going back to, as I said, the onshoring of the industrial plant and the demographical challenges the United States is going through right now. But the perception is probably going to be more one, from the public's view, that the Fed is doing what they need to do to get that inflation under control. And so people are going to see the Fed as the knight in shining armor rather than Bitcoin, which brings another issue to Bitcoin, which is honestly a public relations one. So there's going to be less liquidity as a result of the balance sheet tightening, and there's also going to be less of a PR reason to invest in Bitcoin because the ideology of Bitcoin helping to get inflation under control isn't as appealing when it looks like the Fed's already doing it. Again, all of that's not including the impacts that the balance sheet's tightening has on the Bitcoin market through the Dixie and the SPY. We'll talk about the stock market and the dollar currency index in other videos. But now, to wrap it out, let me show you the direct impacts and the correlations that the balance sheet has to Bitcoin just by overlaying a couple of charts. If we look at the Brave New Coin liquid index for Bitcoin right here on the weekly chart, this is the longest running history of Bitcoin that we have access to. And on this chart, we will go ahead and overlay the balance sheet. Come here to this plus button. You can see I have 4 different charts that I like to overlay. USCBBS, that is the United States Central Bank balance sheet, is the one that we're going to run today. Come down to your indicators, hit this button, Economics, USCBBS, and we'll turn it on. You can see that it is now overlaid over Bitcoin. You can see that there are a few different areas of quite a lot of movement on the balance sheet, either to the upside or to the downside through quantitative easing or tightening. Remember, quantitative easing is the balance sheet going up. Quantitative tightening is the balance sheet going down. I've highlighted the 6 most obvious ones that have occurred in the history of Bitcoin. The first one occurred here between roughly the beginning of Bitcoin through about June of 2011. During that time, there was a significant amount of quantitative easing going on. If you remember to the chart itself, this correlates to the period of more gradual quantitative easing that happened after the 2008 financial crisis. You can see how Bitcoin responded. Bitcoin absolutely moonshot. When that QE flattened out for a time here, you can see Bitcoin was having quite a bit more trouble. You can already see the correlation that I'm drawing here. You take into account the next time that we saw a major round of QE, and we saw the balance sheet rally from 2.8 trillion all the way to 4.45 trillion. During that time frame, Bitcoin went through a major bull market. Following soon thereafter, though, and this has to do with halving cycles as well, but we're just looking at the balance sheet right now, we saw how the balance sheet moved sideways at 4.5 trillion for a multitude of years. During that time, it was not the driving factor on Bitcoin. Things like halving cycles in the stock market were. So this was not having an impact on Bitcoin because it wasn't doing anything. But when the balance sheet started to move down and we saw quantitative tightening coming out of 2018, we were seeing a little bit more inflation. The Fed was trying to get things under control. That also led to a drop on the stock market. And of course, it correlated with a major drop on Bitcoin. Whenever you see QT, quantitative tightening, there's a bear market in Bitcoin almost invariably. In fact, absolutely invariably. The next time we see a shift in the balance sheet's policy is during the beginning of the pandemic. And you saw the quantitative easing go into hyperdrive, and we saw the balance sheet go from 4.1 trillion all the way up to 7.1 trillion, a $3 trillion increase in the span of just 3 months. Now, you might look at the chart and say, but that's not that big of a movement. Well, just keep in mind, in between these 2 lines right here, where you can see that huge jump in the balance sheet, we saw Bitcoin almost to the day rally from $4,000 to $10,400. In less than 3 months, Bitcoin rallied 160% in relation to that movement, and the main effects of that movement would be felt a little bit later. Then we get into the quantitative easing that took place in a more slow, controlled fashion following the huge injection of liquidity at the very beginning of the pandemic that the Fed put in place to try and mitigate a recession. During that time, we saw a huge amount of spillover from this original event, leading to bullishness in Bitcoin, and then the general uptrend here also led to a general uptrend in Bitcoin, where Bitcoin added 500 to 600%. Then you get to the end of that phase and Bitcoin begins going into a bear market. Why? Well, there's multiple factors having to do with inflation, the war in Ukraine, the stock market, the Dixie. But in this case, right around November, December, January, people knew it was on the horizon that the Fed was going to stop increasing the balance sheet at some point soon. And you can see the peak of the balance sheet came in at 8.95 trillion, just shy of $9 trillion, around April of 2022, which was about 4 months into the bear market. From that point, as soon as the balance sheet started going down, again, even going back to April, as soon as that balance sheet started having reduction and the Fed started rolling off their investments, we saw an absolute bloodfall on Bitcoin. Bitcoin dropped 63% in 77 days because when this balance sheet started getting rolled off, people knew that it wouldn't stop anytime soon and it would go on for years. So all of it got priced in the span of 3 months. On top of that, we also, of course, saw the fall of Luna and the war in Ukraine. But I hope you can see how the balance sheet has impacted the history of Bitcoin. And this is not the only way that the balance sheet impacts Bitcoin. It also impacts a plethora of other factors, which also come together to impact Bitcoin, which we'll cover in future videos. But for today, I wanted to show you how the balance sheet impacts Bitcoin. And now to wrap it out, I want to let you know where we're going from here. As you can see in history, it is generally very difficult for Bitcoin to go into a major rally when the balance sheet is being reduced at a very fast rate. We've seen that recently. We've also seen that during 2018, the last time that the balance sheet was being reduced. We saw a bear market when that occurred. Rolling off of mortgage-backed securities and treasuries from the balance sheet, again, leads to theoretically decreased inflation, but more importantly, a lot less liquidity in the market and a lot higher credit costs, much higher capital costs, and it makes it harder for people to invest in what they consider to be more risky investments such as Bitcoin and crypto. When the United States economy, which is worth around $30 to $40 trillion, depending on how you measure it and what actual monetary unit you go by, loses $9 trillion of liquidity in 3 years, that makes the next 3 years much harder for Bitcoin. And it does bring a little bit of a damper on the idea that Bitcoin's going to go through an explosive bull market of $300,000 or $400,000. I think Bitcoin will go through a bull market, despite the balance sheet moving to the downside for reasons that we'll cover in another video having to do with the halving cycles. But for this video in particular, I want you to understand the balance sheet being shrunk over the next 3 years is going to be a consistent bearish debuff to the price of Bitcoin, and it's one that we're going to have to pay very close attention to, because if the Fed is committed to $100 billion a month of roll-off, that is going to lead to $100 billion a month of liquidity leaving the market, which then cannot be invested in Bitcoin and crypto. And by the way, $100 billion, that's kind of in the same ballpark of the total military aid that's been provided to Ukraine. Just to give you an idea of what we're rolling off every month on the Fed side. Are we going to see a bull market? I think so. I think we'll see a bull market in the next 12 to 18 months, and it really pick up going into Q1 of 2024 for a multitude of reasons. However, the balance sheet being shrunk is something that will probably make that trend significantly harder. I hope you enjoyed this video, and if you did, there's a couple things that you can do. First and foremost, subscribe to the channel, hit that like button. It helps to support us exorbitantly. And if you want to learn how to do technical analysis like I just showed you, there's one place to do it, and it is the best place in all of crypto to do it, and it is Club DeFi's Principles of Technical Analysis. Over here in Principles of Technical Analysis, you are going to get access to over 60 videos that will teach you everything you need to know to be able to do the kind of analysis on Bitcoin and cryptocurrency markets that I do every single day on our live stream and throughout the videos that we do here on the CryptoJeb YouTube channel. You're going to learn about everything from the very basics, like how to read a chart, what the timeframes are, and common fears that you're going to run into as a trader and investor in the cryptocurrency market. Then we're also going to talk about all the different patterns, candlestick analysis, and indicators and oscillators that you're going to need in your analysis to be able to make the most of your trading and investing journey here in the cryptocurrency space. I've always said for the more than 5 years that I have been doing this in cryptocurrency that the best investment that you will ever make is an investment in yourself and your education if you're trying to become an investor. The absolute best investment you will ever make is one in yourself and in your education so that you understand how to succeed in these markets. That's why we make these videos, and that's also why we make Club DeFi. We have a singular purpose to help you achieve financial sovereignty. So if you want to achieve financial sovereignty, let me and our team help you to get there. Go to cryptojeb.com, hit the enroll now button, and sign up for Club DeFi's Principles of Technical Analysis. Don't forget, if you were a former CT2A member, you still have access to CT2A, but you also have a 25% off coupon code waiting for you for Club DeFi's Principles of Technical Analysis. And on top of that, if you are a part of the Club DeFi beta, then you've got a discount waiting for you, which is as large as your membership to Club DeFi was. So if you spend $125 on Club DeFi's beta, then you will get that as a coupon code for Club DeFi's Principles of Technical Analysis. If you're in both those camps, you get whichever coupon code is bigger. Shoot us an email at support@cryptojeb.com if you're in either one of those camps, and we'd be more than happy to generate that code for you so that you can get learning today. All right, guys, that's all I got for you today. Before I go, I do just first want to thank each and every single last one of you for watching, as always, and I will see you guys in the next video. Peace. Oh, I got a real good feeling.